to order. Welcome to meeting number 32 of the House of Commons Standing Committee on Finance. Before we continue, I would ask all in-person participants to consult the guidelines written on the cards on the table. These measures are in place to help prevent audio and feedback incidents and to protect the health and safety of all participants, including the interpreters. You will also notice a QR code on the card, which links to a short awareness video. I just ask that please wait until I recognize you by name before speaking. And for those participating by video conference, click on the microphone icon to activate your mic, and please mute yourself when you are not speaking. Pursuant to Standing Order 1082 and the motion adopted by the committee on Monday, March 9th, 2026, the committee resumed its study of household debt in Canada. I would like to welcome all of our witnesses. You will have 5 minutes for your opening remarks, after which we will open the floor to questions. In this first panel, we have three organizations. We have the Financial Consumer Agency of Canada, Office of the Superintendent of Bankruptcy, and Statistics Canada. So we'll start off with 5 minutes each in that order. We'll start with Financial Consumer Agency of Canada. Go ahead.
Thank you, Mr. Chair. Good afternoon, members of the committee. My name is Shireen Bensfee-Miller, and I'm the Commissioner of the Financial Consumer Agency of Canada, or FCAC. I'm joined today by the Deputy Commissioner of Insights, Policy and Financial Literacy, Dr. Manon Bombardier, and Deputy Commissioner of Supervision and Enforcement, Frank Lafranco. Nous nous réjouissons d'avoir l'occasion de contribuer à l'étude.
We welcome the opportunity to contribute to the committee's study of household debt in Canada. FCAC's research shows that many Canadians are under real financial strain. According to our monthly financial well-being survey, 40% of Canadians reported that their debt had increased in 2025, up from 35% in 2020. Nearly 2/3 say they are carrying non-mortgage debt, with parents and those aged between 35 and 54 being the most indebted. Many organizations have expertise in household debt, including our colleagues here today, as well as previous witnesses before this committee.
We work at the intersection where consumers meet financial institutions and others in the financial ecosystem. FCAC's mandate is to protect financial consumers and to empower them to make informed financial decisions. Our role is to regulate consumer protection by supervising federally regulated financial entities while also building financial literacy, studying trends and issues that affect Canadian financial decision makers. Understanding consumer financial challenges enables the agency and its ecosystem partners to develop evidence-based approaches that strengthen Canadians' financial well-being. For example, in early 2023, our research was showing that Canadians were struggling to manage their mortgages. In response, FCAC issued a supervisory guideline for banks to proactively contact mortgage holders showing signs of financial distress that could put them at risk of default. As of December 2025, account holders for more than 165,000 at-risk mortgages had been contacted by their banks, and Canadians had avoided over $700.85 million in late payment penalties and fees. Another aspect of consumer protection relevant to the committee's study is our oversight of banks' compliance with disclosure requirements. Clear disclosure for products like credit cards, mortgages, and lines of credits is essential to help consumers make informed decisions. FCAC's supervisory focus is on preventing harm, but when serious market conduct breaches occur, we impose penalties and require banks to reimburse affected consumers. Since 2024, more than $130 million have been reimbursed to consumers and business accounts as a result of our work. In addition, over the last 3 years, regulated entities have paid nearly $27 million in penalties for violations of consumer protection provisions. FCAC's research also supports data-informed policy development to respond to the evolving marketplace. Our research has contributed to ongoing legislative and regulatory changes to strengthen consumer protection and support financial well-being, including the Financial Consumer Protection Framework in the Bank Act, the modernized commitment on low-cost, no-cost accounts, which took effect December 1st, 2025, and new regulations capping non-sufficient fund fees at $10, which came into force last month. These changes benefit all Canadians, but particularly those who are financially vulnerable. We are now preparing a report on the structure, level, and transparency of fees charged by Canadian banks that will support the Department of Finance's work to improve competition and innovation in the banking sector. And we are reviewing banks' implementation of legislative requirements to offer financial products and services that are appropriate for consumers' needs and circumstances. En conclusion, la dette des ménages.
In closing, household debt is a significant challenge for many Canadians, and FCAC will continue to do our part to support them with the tools available to us under our mandate. Consumers should not face the debt challenge alone, and no bank should profit from a poor consumer outcome. The onus is on the entire financial ecosystem, including governments, industry, and not-for-profit organizations to support better outcomes for financial consumers.
With that, I conclude my remarks. I look forward to your questions. Thank you.
Thank you, Ms. Miller. That was right on time. Next, we have the Office of the Superintendent of Bankruptcy.
Thank you, Mr. Chair. Honourable members, thank you for the invitation to appear before you today, and thank you to each of you for the important work you do on behalf of Canadians. I'll deliver my remarks in English to avoid any translation challenges, but would be pleased to answer questions in either official languages. Je m'exprimerai en anglais afin d'éviter tout problème de traduction.
I will deliver my remarks in English to avoid any translation challenges, but I'd be pleased to answer your questions in either of the official languages.
Superintendent of Bankruptcy, or OSB, and Canada's insolvency system with a focus on consumer debtors. I'll then highlight a few key data points relevant to household debt in Canada. A well-functioning insolvency system is a key pillar of the economy. It supports investment and creditor confidence, provides an orderly process for creditors, and gives honest but unfortunate debtors a fresh financial start. As Superintendent of Bankruptcy, a Governor and Council appointee, I carry out statutory oversight and enforcement responsibilities at arm's length from the government to help ensure that the system operates as intended. The OSB is a part of Innovation Science and Economic Development and oversees the administration of the Bankruptcy and Insolvency Act, as well as certain aspects of the Companies' Creditors Arrangements Act. We license and regulate insolvency trustees, supervise compliance, maintain public records and statistics, handle complaints, and pursue civil and criminal enforcement when required. We also have directive-making authority, which allows us to respond nimbly to operational and market developments. The OSB is a VoteNet organization and is almost entirely funded through levies and fees paid by system users. Licensed insolvency trustees play a central role in the system. They are required to assess a debtor's financial situation and explore all available options, including non-insolvency options. For consumer debtors, formal insolvency options include bankruptcy or a consumer proposal, which allows assets to be retained while creditors vote on a repayment plan. Upon filing, debtors benefit from a stay of proceedings, repay reasonable amounts based on their means, and if they meet their obligations, including participating in 2 insolvency counseling sessions, are discharged of most of their debts. Debtors have clear duties, including full disclosure and cooperation, and there are consequences for non-compliance. That said, most consumer debtors in Canada are honest and cooperative. There were just over 137,000 consumer insolvency filings in 2019 and just over 140,000 in 2025. For context, the highest volume on record was during the 2009 recession, when more than 151,000 filings were recorded, at a time when Canada's population was smaller. It's important to highlight the fact that the insolvency rate in Canada has been relatively stable for over a decade, excluding the pandemic years, ranging between 4.2 and 4.6 filings per thousand since 2011. Insolvency is also a lagging indicator, meaning filings often rise after financial stress has already taken hold. Evidence also suggests that financially distressed Canadians often delay or avoid filing altogether, even when insolvent, which can limit their options and worsen their outcomes. The OSB continually monitors system capacity and integrity. We recently concluded Canada Gazette 1 consultations on regulatory changes aimed at improving efficiency and accessibility, and we continue to look for channels to reduce red tape while strengthening enforcement tools. Beyond regulation, consumer awareness is a key priority. We work closely with partners such as the Financial Consumer Agency of Canada, provinces and territories, and the Canadian Association of Insolvency and Restructuring Professionals to stay abreast of key issues and to help Canadians find reliable debt advice early. We are also actively addressing risks in the debt advisory marketplace, where some actors may mislead consumers or charge unnecessary services for unnecessary services, ultimately harming already vulnerable individuals. Canada's insolvency system is well regarded internationally and plays a critical role in supporting both economic stability and individual financial recovery. Thank you again for the opportunity to appear, and I look forward to your questions.
Thank you, Ms. Lang. Next, we have Statistics Canada.
Monsieur le Président et
Thank you, Chair,
les membres du comité.
and thank you to the members of the committee. I'm Jennifer Withington, and I'm Assistant Chief Statistician responsible for economic statistics.
Today, we are here to share insights on Canadian household debt and financial vulnerabilities as captured in our extensive framework of credit and socioeconomic statistics. This framework encompasses quarterly and monthly measures of household debt and borrowing, including details by loan product and lender, distributional statistics highlighting how debt is allocated across socioeconomic groups by age, and with supplemental information on prevalence of non-bank lenders. With these data, we can articulate the financial position of Canadian households, including their debt burden, asset holdings, and net worth. We can also provide relevant indicators of financial vulnerability, such as leverage ratios and debt service ratios, which represent both stock-to-flow and flow-to-flow perspectives. Le bilan national trimestriel du
Canada's
et
comprehensive and official accounting of household debt. It shows that at the end of 2025, household debt had surpassed $1 billion, with 1.77 in outstanding debt for every dollar of disposable income. By comparison, at the end of 2019, that is to say 7 years ago, $800 billion less in outstanding debt. Yet, this represented a higher proportion.
Toujours, à la fin de 2025,
Also, at the end of 2025, debt servicing costs, the payments Canadian households are
environ 15%
represented roughly 15% of their income. By comparison, household expenditures on food and beverages represented 9.4% of their disposable income.
households hold significant assets in the form of real estate and financial assets. The value of their households' total assets was more than 5 times larger than their level of debt at the end of 2025. In terms of composition and lender, nearly 3/4 of households' loan liabilities are in the form of mortgage debt, and nearly 90% of those are with Canadian charter banks and credit unions. Among non-mortgage debt, lines of credit, including home equity lines of credit, represent nearly half of outstanding balances, while credit card debt accounts for 1/5 of all non-mortgage borrowing from banks. As the committee has heard from previous witnesses, these macroeconomic aggregates, which are critical to establishing accurate levels and lender relationships, do not tell the entire story of the types of households that may be experiencing greater financial hurdles. However, Statistics Canada expands the aggregate perspective with distributional information that presents the financial portion of households by characteristics such as age group, income and wealth quintiles, and home ownership status. These data show that the income and wealth gap between the lowest 2 income quintiles and the highest, that had narrowed since 2020, has started to reverse course. These data highlighted how between 2022 and 2024, the youngest households have eschewed the housing and mortgage market as affordability concerns and borrowing costs forced them to delay the prospect of home ownership. At the same time, older households, those aged 55 to 64 years, increased their average mortgage debt at a faster pace than younger households, which may indicate direct or indirect attempts to assist younger relatives with the purchase of a home. À l'avenir, des taux d'intérêt encore élevés.
Or still elevated interest rates and continued mortgage renewals and
Risque de compliquer davantage.
are likely to further challenge households, especially those more vulnerable to economic or financial shocks.
Monitoring these trends closely to provide a clear and comprehensive picture of Canadians' financial resilience in the face of economic pressures. We are here to answer further questions from committee members. Thank you.
Thank you, Ms. Withington. So that concludes the witnesses' testimony. We'll open it up. It's the first round, 6 minutes. Mr. Lefebvre.
Merci, Monsieur le Président.
Thank you, Chair. Thank you to our colleagues and to our witnesses for being here today. My first question is for Commissioner Miller. Currently, within the G7, Canada has the worst indebtedness for households among the G7 countries. We're at 103% compared with Italy, which is at 36%. So if you were able to put into place one measure to help Canadians, what would it be?
Merci pour la question.
Thank you for the question.
Le Président.
Thank you, Chair.
De m'imaginer dans la
I'm not in the habit of imagining things that we could invent, because I think that the tools we have now are very useful. And the supervision of banks and the tools that we have to assist people in being more familiar with their finances.
What we found, we do a monthly financial well-being monitor, so we track very closely to see how Canadians are doing and to see how we might help them with better tools and better supervision of the financial institutions. And so we have seen trends of borrowing increasing and percentages of income that are being spent on debt. But we also see that there are measures being taken to help both to prevent indebtedness, reduce indebtedness, and manage indebtedness. And I would say, if you were asking me in my fantasy life, I would do more of those things. I would create more programs like our low-cost, no-cost account commitments, like the NSF fee cap, setting up e-alerts, things that will help people, particularly vulnerable Canadians, to manage their finances, because really what you want is you want a resilient population that can make good decisions given all the factors that they're facing. So, something like the mortgage guideline, which we put in place in 2023, has really helped to put banks in a position where they actually have to reach out to consumers that might be at risk of over-indebtedness to make sure that products are appropriate for them as the law requires, and that they are not renewing at a rate that they cannot sustain.
Merci.
Thank you. Currently, we know that there are many people having a hard time paying their mortgages, and they're having a hard time adhering to their commitments. Do you think that this situation is going to get worse over the next 2 years?
Je vais passer la parole.
I'm going to pass the floor to Dr. Bombardier, who is responsible for our insights and research. Thank you very much for the question. As the Commissioner mentioned, we have a number of tools that allow us to measure and follow what consumers are telling us. We do a lot of surveys on a monthly basis, and every 5 years we also work with an ecosystem of players in the financial system. We're not the only one. There, of course, are colleagues here with us at the table, but there are also many external organizations who do things to assist Canadians who are facing debt-related challenges. And within our strategy on financial literacy, we have a measurement plan, and we're evaluating the previous version of it, and we're undertaking the planning for the next version, and it's going to be based on measures. Your projections for the next 2 years, well, do you think it's going to continue to increase? If there's a significant impact on the ecosystem, then we have a good opportunity to improve the situation, but it requires a whole of ecosystem approach, and that's what we're doing with our financial literacy strategy. We're working along with our partners in the ecosystem. My next question is for Ms. Lang. The total number of insolvency and bankruptcy files has increased by 8%. In February 2026, the number of bankruptcies went up by 6.1%. And I'd like to hear from you. How do you see the next 2 years, given inflation that's been the case over the last year? The reasons for a bankruptcy are complicated and numerous.
La guerre en Iran.
And given the war in Iran.
Ça se peut.
And if trade continues, it may be the case. According to the Canadian Association of Insolvency Professionals, there in 2009 we had the second highest level since the creation of the data collection by the superintendents of bankruptcy. So at this time, it was the result of the cost of life, not as a result of an elevated unemployment rate. Does this concern you?
That Canadians are struggling, but the system is there for them. Right now, our insolvency rate, as I provided in the materials, has not actually increased significantly. During the COVID recession, we had a very deep
Thank you, Ms. Lang.
Drop.
That's
Okay,
time.
apologies.
Next, we have Mr. Letel for 6 minutes.
Merci beaucoup, Monsieur le Président. Alors, bonjour.
Thank you, Chair. Perhaps we can continue on the same subject.
C'était vraiment...
You mentioned that it was after the 2009 or during the 2009 recession that we experienced the most serious problems in terms of insolvency. So I assume that the main factor behind a deterioration of the situation is a recession, a loss of jobs, loss of income. It's more so that than other factors, which of course are significant, but are perhaps less significant in this context. Yes. As I said, there are many reasons for insolvency. Sometimes it's losing a job. Sometimes it's an illness, a divorce. So it's fairly complex. But if there is a recession, yes, we would expect an increase. Very good. Thank you. So perhaps we can move over to StatsCan. Speaking of recession, not to put words in your mouth. You mentioned that total household debt is $3.2 trillion.
Ce qui a l'air très élevé, bien sûr.
Which is very high. And you do a lot of analysis, you have a lot of tools. And I believe that you calculate what the net debt of households is. And could you tell us, in this 3.2 trillion of total debt, what is the net debt for Canadian households, if you have that information?
Yep. So if we're talking about the net worth of households, all of their assets, that was what we alluded to, where households have 5 times as many assets, non-financial and financial, as they have debt. So net worth is over $18 trillion for households. It's not evenly distributed, like financial assets. More than 2/3 are held by the top wealth quintile. And I just want to note that for the OECD, Canada is one of the countries that ranks at the top of the list for net worth to disposable income, even though we're ranking highest for the debt to disposable income.
Correct. And that is one of the issues that sometimes gets lost in translation, is the fact that when one talks about debt, one should also compare debt with the assets. Now, one of the big problems is, of course, the distributional component. Usually, the people that have a lot of debt may not necessarily have that many assets. Would you say that the segments most at risk are perhaps those households that have a lot of relatively large levels of non-mortgage debt? Presumably, if you have a mortgage, of course, you have an asset, you have a house, and your net position may well be quite advantageous. But those folks that don't have that many assets and have reasonably elevated levels of consumer debt, those are, by definition, the most vulnerable. And perhaps it should be on those that we policymakers should be paying more attention.
Yeah, if you want to start.
So I would say that there is more of a preponderance of non-mortgage debt in the lowest income quintiles. And the wealth that we were referring to, the wealthiest quintile has approximately 68% of financial assets and 65% of net worth. So I think that I would concur with your statement,
Yeah.
Matthew.
Thank you. Et peut-être maintenant, je pourrais revenir à la...
And perhaps we could now return to the FCAC,
qui était mentionné souvent.
an issue that has often been mentioned,
2024 et même 2025.
and perhaps in 2024, 2025, we were very concerned. And a number of commentators referred to this, speaking about a mortgage debt Armageddon. And as consumers had to refinance their mortgages, and which
5%
with an interest rate of often 1.5%, but if you need to renew your mortgage at 4, 5, 6%, then that would trigger.
C'est pas ça ce qu'on a, on n'a pas assisté à ça.
So this hasn't yet happened. Do you have a hypothesis as to why this kind of...
I think I'm going to pass the word to Frank, but one of the things that I would say is that one of the things that an agency like ours does is we look at trends. That's what our research is for. We look at trends. So we do actually look at the way in which mortgage renewals are going to...
Thank you, Ms. Miller. That's the time for that round. We can definitely come back. Next, we have Mr. Guérin for 6 minutes.
Merci, Monsieur le Président.
Thank you, Chair. It's great to see you in your seat. Hello to my colleagues. I'd like to continue in the same vein as
Madame Lang,
for Ms. Lang. We know that the number of personal bankruptcies increased a lot during the 2009 recession. You mentioned this. But that the numbers are not as alarming as they were then. But in a certain sense,
certains ménages sont
that a number of households are in a fragile situation. We're not at a historic level of personal bankruptcy, but the question needs to be asked,
fragilisés par leur endettement.
Fragile as a result of their indebtedness. And so if we were to experience a recession over the next months or years, if this occurs, and of course we hope it doesn't happen,
Pourrait verser.
financial situation, these people may end up moving toward bankruptcy. So how can we calculate the vulnerability of these households with respect to this potential scenario? And do you think this level of vulnerability has increased over the last years?
Pas à
I'm
répondre à cette question.
the best suited to answer this question, given my responsibilities as commissioner.
OK.
If that makes sense.
Ben, oui et non, là, parce qu'on était.
Yes and no. I'm not sure if another witness would like.
Économique se dégrade.
If the economic situation deteriorates, do we know whether households would be vulnerable in terms of more insolvency? Perhaps our colleagues from Stats Canada would be better suited to answer the question.
Merci.
Yes, we can answer.
One indication is the debt-to-income ratio, and since the pandemic, the debt-to-income ratio had declined significantly as since the first quarter of 2023, where credit market debt increased 4.3%, while household disposable income has jumped 8.5%. Alors, ça monte un peu le dernier trimestre.
So this is shown a little bit in the last quarter. And I can also add something.
It's the lowest income quintile households, where we see 4 times the level of debt as they have of income. And we also see in that same product, which links income to consumption to savings to debt, we do see that of the lowest wealth quintile or income quintile, we do see that their transportation costs, their shelter costs, their food costs are in some cases actually exceed their overall amount of disposable income. So
Donc, si je peux me permettre, ce serait par exemple ces ménages-là du quintile le plus bas, du premier quintile.
At the lowest quintile, they would be vulnerable to an increase in the price of fuel, given.
Certainement.
Certainly.
October showed that 27.7% of Canadians were finding it difficult to make ends meet. So to give you a bit of a benchmark, et oui, certainement, s'il y a une hausse de prix de gasoline, ça va affecter ceux au niveau quintile le premier.
This will affect the first quintile. So in a sense, some parties are proposing that we completely abolish
L'ensemble des consommateurs.
for all consumers. So what you're telling us is that there's a part of the population that's very vulnerable, and that might. But I'll now move over to Commissioner Miller.
Vous avez comme mission d'élaborer la stratégie
Your mission is to develop a national strategy for financial literacy. So in Canada and possibly in
financière au Québec et au Canada.
We're good with financial literacy. How do we compare when it comes to other countries? Do we have a lot of work to do?
La parole à Dr. Bombardier. Je vais dire que je me retrouvais dans
I'd like to tell you that I was recently at an international event, and
la réponse était
and the answer was speak to Canada.
Very well, but in terms of financial
Est-ce qu'on est bon à mesurer les...
But are we good at measuring financial literacy, or are Canadians and Quebecers
développés
with other developed countries? Our score is pretty good. We're among the highest internationally in terms of financial literacy. To keep working, we need to figure out what's working, what's not working. We're working with our partners to see what we can do to improve the situation.
Financial well-being,
And so what we can do to increase financial well-being. And very quickly, we have 15 seconds left. Are you concerned by financial misinformation on social media? Is this undermining your work? What's on TikTok and influencers are saying? Yes, we're concerned by it. Everyone in the ecosystem is. Thank you.
Concludes round one. Round two, we have Pat Kelly starting off for 5 minutes.
Thank you, Chair. To the Superintendent, we had testimony in the last week that credit is growing, that indebtedness is increasing, and that people are dealing with their higher debt service cost by depleting their savings, refinancing existing debt, so in other words, stretching the problem over a longer period of time, compounding it in the long term, and also cutting back on consumption, including necessities. We have just seen a jobs report with a loss of 108,000 full-time jobs in the last month for which we have data. Are you concerned that as unemployment rises, debt service cost and the debt burden rises, that this may affect the solvency of Canadians?
Yeah, I think that the conditions are ripe for it affecting the solvency of Canadians, but there are, so credit counselors can be there, reputable credit counselors to help them budget before they have to find an insolvency solution. And the insolvency system is there to provide them with the tools and resources and a fresh financial start. But
okay,
yes.
but if I may, all the counseling in the world isn't going to allow a person who has lost their job, who has taken on debt because of increased cost of living. This isn't a matter of people's financial literacy. This is a matter of loss of income.
Yeah, as I said, job loss is one of the main reasons for insolvency. So certainly in job loss situations, that's often what we see.
All right. So the unemployment, is that likely the key driver in people's inability to make their minimum payment?
One key driver, but it's certainly a major one.
Okay. We also heard that while in the last year, overall credit increased by the indebtedness of Canadians increased by more than 4%, but the number of debtors only increased by a little over 1%. So in other words, people are getting deeper in debt. We're not seeing new home buyers, for example, getting into home ownership. What we are seeing are existing debtors getting deeper in debt. Does this concern you as superintendent of insolvency? It's
the same category of concern that people are in difficult financial situations and will need to look for an insolvency situation, an insolvency solution. I think where we sit today with the numbers and the macroeconomic conditions, we are expecting a rise in insolvencies. Yes.
Okay, thank you. To Statistics Canada, I believe in your opening statement you said that food is now up to 9% of the average consumer's budget. Okay. We have Fraser Institute reports that taxes are now 43% of the average family budget. How does housing fit into that? You've got 43 going to tax, you've got 9% going to food. Housing is extraordinarily expensive. Where's housing in this?
Go ahead. Okay, sure. So we don't have precise numbers on the housing side, but that's something we could follow up with. We were quoting details from our household final expenditure series, which include housing-related expenses, transportation costs.
Okay, so you had a food statistic. You don't have a housing statistic?
We have there are different items under our household expenditure.
Okay.
We've got some slightly older data from 2023. Where the homeowners without mortgages spent about $14,000 on shelter, and those with mortgages spent on average $38,000 on shelter.
What about renters? Renters are a large portion of the population.
Yeah, they are a large portion of the population, but they may not be indebted in the same way with the mortgages.
Sorry, they're not indebted, but they will have non-mortgage debt. And their ability to service that non-mortgage debt will be affected by their rent.
Certainly.
Okay. So non-mortgage debt is, so 2/3 of households have significant non-mortgage debt. Is that correct? Did I hear that?
We do aggregate numbers. We don't necessarily have counts. We do have some information on the number of households with a mortgage, 6 million households in Canada.
Okay, no, we're talking about non-mortgage.
Exactly, that's what I'm saying. We don't have precise numbers on our side.
I've only got about 20 seconds left, and I did want some clarity on the statistics that you discussed about the net worth quintile and how the top quintile affects the numbers. What is the cutoff? Like, what's the minimum to be in that top quintile?
Very short answer.
So the wealth quintile is the top one would be the top 20% in terms of wealth.
And how much? What's the number?
That's Mr. Kelly. Yeah, that's time.
So the number of people.
The dollar amount.
Thank you. We can continue in the next round. Next, we have Mr. Sawatsky. 5 minutes.
Thank you, Chair. Thank you to the witnesses for coming today. So over the past several years, the federal government has taken steps to strengthen consumer protection frameworks, including enhanced oversight of financial institutions, expanded tools for consumer awareness. At the same time, we do recognize that many Canadians continue to face pressures from high borrowing costs and cost of living challenges. So in that context, could you speak to how effective current consumer protection measures have been in supporting Canadians with debt obligations?
Why don't you? It's on.
It's on. Thank you for the question, Chair. So yes, in 2022, Financial Consumer Protection Framework was put in place that introduced 60 new or enhanced measures for consumer protection. Some of the new measures are quite meaningful and consequential to consumers achieving positive financial outcomes and relevant to the conversation around debt. I'll offer by example a new provision in relation to the obligation for banks to offer products that are appropriate for the financial circumstances of consumers that meet their financial needs and can lead to positive outcomes. In the context of supervision, we supervise on a risk basis, obviously paying attention to the issues that are most likely to cause financial harm or institutions themselves that are high risk. In that, what I would say is a bell curve. We always get some banks that are performing quite well in relation to the compliance, others that are in need of incentive and guidance, and others where non-compliance does occur. So our work is very much focused on ensuring that issues of non-compliance are dealt with by way of results. The Commissioner mentioned in their opening remarks that more than $100 million in remediation has gone to consumers who would have been harmed by some level of non-compliance in the past year. Over the last year as well, we've issued more than 400 enforcement actions, all of which require corrective action on the part of the institutions to remediate the problem and remediate consumers if necessary. And we govern our work by way of various action plans and compliance agreements when there's a need to put corrective measures in place that deserve a bit more time. So ultimately, the protections consumers benefit from can enable positive outcomes and protect them from financial harm. It's highly dependent on the compliance of institutions, and hence we play an active role in supervising their compliance with those obligations.
Thank you. And do you see any opportunities to further strengthen protections in general?
Yeah, you may be aware of the Department of Finance, who's putting in place with the budget announcements and Bill C-15. There's a number of measures in there that improves protection for consumers and reduces fees, for instance. So we're involved in reviewing the fees of the banks in Canada, and that will inform hopefully some next steps in terms of policy measures to further improve the financial well-being of Canadians.
And if I could add, there are other measures, for instance, the fraud strategy, which will allow us to monitor the both prevention and detection measures that institutions take to prevent fraud against consumers, because that is a huge risk to consumers' financial well-being and one that is growing in scale and in sophistication every day. And that initiative will also be multidimensional, not just in the financial sector, but will also involve the telcos, and will involve multidimensional prevention and protection measures.
Thank you. That's good to hear. This topic has come up a few times with scam texts and collaboration with telcos. So that's good to hear. It was brought up financial literacy. I just wanted to see if maybe you could provide some context to like a younger generation and how they're dealing with financial literacy, and if there's any kind of gaps you could identify that could be addressed to ensure that younger generations are being more financially literate.
Yeah, so we, as part of our research, we look at young women in particular. So we've worked with Chatter High, so it's an application that exists. So we've worked with universities to put in place an intervention amongst young women to improve their financial literacy and improve their behaviors towards saving more money. And with those experimentations, we've shown that with simple nudges, to help them achieve put in place the right behaviors at the right time, they can improve their financial well-being. So we're doing experiments like that. We did another one with credit card debt, where 35% of the participants reduced their debt.
That's time. Next, we have Mr. Garand for 2.5 minutes.
Merci, Monsieur le Président.
Thank you, Chair. I'm going to continue with you, Commissioner Miller. Myself, I organized a viewing event to watch some resources on fraud prevention, and it's provided by the RCMP, by your office, if I'm not mistaken, and it serves to raise awareness on the whole telecommunications system, the police system, the financial system, to make them aware of issues related to fraud. I think it's a great initiative, and I've said in public and in private that at a certain time, banks need to assume more responsibility for fraud. Like it was done in the UK, it seems to me that whenever we talk about fraud with bankers, they tell us that it's everyone's fault except theirs. And so I'm wondering, do you think that it would be better if banks could assume more responsibility for fraud? It would incentivize them to invest more in their systems and in prevention, as was the case in the UK, where fraud has been reduced significantly, and there's been an 80% reduction. Do you think that this could be a way to reduce fraud? Thank you. Well, I need to know what the investments are being made in prevention and in protection against fraud. Because we don't really have a way to figure out what they're doing in a detailed fashion. Would you not say that if they were to be obliged to assume more responsibility, that would incentivize them to investing in... Do you think this would be a way to incentivize them?
I think for fraud prevention and deterrence, what has shown to be effective is transparency. And one of the things that we need to know is, what are the banks actually doing? And if they're not doing enough, then we can, as regulators, require them to do it. One of the things that I will be doing is I will actually be providing a report to the Minister of Finance on this annually, in order to make very transparent what investments are being made across the sector, so that banks can actually show what they're doing to prevent fraud and what responsibility they are taking. Because you are right, there is a responsibility for the banks to take relative to fraud.
Thank you, Ms. Miller. That concludes that round. This is our last round. First, we have up Ms. Cabina for 5 minutes.
Thank you, Mr. Chair. Commissioner Miller, in your opening statements, you mentioned that approximately 40% of Canadians reported that their debt had increased in 2025. Could you expand on that?
I think it's my colleagues from Statistics Canada who are best placed to actually expand on it. We find this because we do a monthly well-being monitor. So we ask them fundamental questions about their financial resilience and their financial wellness. And so we get data like this, but we don't unpack it the way my colleagues at StatsCan do. Would you like me to pass it to them?
Sure. So I can start off. Yes, the debt has gone up. Part of that is with the rising interest rates. It's been primarily in the form of mortgage debt, whereas Canadians have generally been decreasing their non-mortgage debt.
That nearly 2/3 say that they're carrying non-mortgage debt. So out of the people that are taking on debt, what is driving that debt if it's not mortgage?
So it is mortgage. Sorry, just to clarify, it is mortgage debt that they're taking on. The non-mortgage debt has gone down. They may still have non-mortgage debt, but it has been at a lower rate. Matt?
And I'll just clarify, we measure values of debt. We don't necessarily measure which households have a certain type of debt. And so I think that's the challenge. And debt, it's a nominal idea. It tends to increase over time given inflation, given just what's going on in the economy. So that's why we do like ratios. We look at leverage ratios, debt to income. And that's where we do see debt to income for the lowest income quintile has gone up, whereas other income quintiles has seen their debt to income ratio decline.
Right.
Over the last 5 years or so. So we are seeing that kind of disconnect when you break it down further.
Yeah.
Instead of just looking at the big picture.
And I think that's actually an important point because, of course, we're looking at the headline saying 177% or $1.77 of debt per income, but that's, of course, an aggregate number. Once you remove the top income earners, it becomes worse. So what is the figure for the most vulnerable?
So we don't necessarily define the most vulnerable. We do see it among low income quintile, low wealth quintile.
Low income quintile.
Exactly. Like there are groups where you might expect some more financial vulnerability. For the lowest, at the end of 2025, we saw a ratio of 433%.
And what makes up that 433%?
So this is looking at all of their debt. So whether it's mortgage or non-mortgage,
right.
And you could expect some quintiles could have different mixes of debt. There
right.
might be less mortgage with the lowest income quintile relative to non-mortgage. And then it's really just a function of their disposable income.
But for that lowest quintile, the 433%, can you break that down? Like what makes up that debt?
So I think this is the challenge. We can do some breakdowns,
okay.
But if you're asking, because the problem with our lowest income quintile is sometimes there's high wealth individuals in that quintile. Mm-hmm. You could be a retiree and you're drawing down wealth and you don't have like a lot of income, but you have this wealth you're drawing on. Mm-hmm. So I think our challenge is when we want to get down to some of this granularity to help policy decisions, to help users understand the data, we don't necessarily have those cross tabulations.
Okay. So this morning, MNP released their consumer debt index reporting that 74% of Canadians say that rising food and gas prices are straining their finances and that 43% are within $200 of being unable to meet their financial obligations. So with that in mind, would you agree then that the largest expense Canadians are struggling with are everyday necessities like food, gas, and housing?
So I would say that's particularly true in the low-income quintile where their household, shelter, and transportation costs represent 103.6% of their income. So that's actually more than they're earning at this point. Again, as Matthew alluded to, some of that could be retirees and quite legitimate that they're drawing down their income. And to the earlier question on the what proportion are housing with the lowest income, it was approximately half of their income was going to the housing portion.
Oh, wow.
A little more than half.
I see I have just a few seconds here. So do you believe then that reducing taxes on everyday essentials like fuel would actually provide a meaningful relief to Canadians?
So I wouldn't venture into the policy zone. Thank you.
Thank
we
you.
just have the data.
That concludes that round. Next, we have Mr. Lavoie.
Merci, Monsieur le Président. Merci.
Thank you, Chair. Thank you to our witnesses for being here. The subject is very interesting. I'd like to ask you an easy question. I'm being nice. I'm going to ask an easy question. Perhaps Ms. Lang. Do you think that Canadian consumers have an access to credit that's too easy? In my personal opinion, that's the only thing I can say. I think perhaps yes. And Ms. Miller?
Venture a guess as to whether or not it's too easy. What I do expect is that whatever access to credit they have is appropriate to their ability to pay it, because that's the regulatory requirement for lenders.
Parce que souvent, j'ai travaillé dans les banques.
Because I worked in banks for 20 years, and often what we saw, and I'm continuing what my colleague Mr. Leitao said, in the context of a financial crisis, the first people who are affected are the people who are excessively indebted. These are the first people affected. So in the current context, would it be these people who are more affected compared with, for example, households that have that own houses? And I don't know for whom the question is, Ms. Miller, Ms. Lang, or StatsCan.
Okay, sure. Go ahead.
Sorry. I'll pivot a bit, but just to say we do measure all lenders to households. And I think the idea being that you can go to charter banks, you can go to credit unions, but you can also go to other finance companies. You can go to payday lenders. You can go to all these different entities to obtain financing. So I'm not saying whether it's easy or not, but just to say there are a lot of options that we track in terms of who the lender is.
OK. Madame Whittington, vous avez parlé.
Ms. Whittington, and the numbers were mentioned quickly. You spoke about insolvencies. In 2009, it reached its peak. Can you tell us about the COVID period? We know, or is it true that there was a significant reduction in the number of bankruptcies? And just to paint a picture, what was the decrease?
Pendant la pandémie, on a vu que
during the pandemic, we observed that people's incomes were higher for the majority of households.
Down significantly during the pandemic. We see a few factors that happened. First of all, there was less opportunity to spend money during the pandemic, so that we had quite a reduction in household debt. So households were paying down their debt. They were also bringing some savings. They were putting it into cash and deposits. And at the same time, with the measures to support households, incomes were rising as well.
Ce que je comprends, c'est que durant la COVID,
So as far as I understand, during COVID, people's behavior changed. Their behavior as consumers changed, and
c'est que le comportement.
My understanding is that this behavior has a lot of impact on the level of indebtedness in households. Can we influence people's behavior?
On ne fera pas une pandémie, là. So...
We're not going to organize a pandemic. Well, we'll set that aside as a possibility. But it has a significant impact. I know that during the pandemic, people's savings went up, people paid off their debt, and it was good globally. But in a normal context, and given the international issues that are underway, people have become indebted again. And so, how can this duality influence consumers? Thank you for the question. One of the things we observed is that people don't have enough knowledge, and they need to really put these into action, and that's what our interventions focus on. And when we undertake just brief interventions, for example, a 5-minute quiz, we see a significant change in the behavior of those who participate. 35% of people who were involved with our debt-related programs will pay off their debt fully compared to the control group. So 35% is quite a bit. And it's a pilot project right now, but we're trying to bring these experiments to the national scene. But so behavior is important, but knowledge is as well.
All the witnesses for being here. We will now suspend for a few minutes to welcome our next witnesses. Thank you. Welcome back. We'll resume the meeting now. I would like to welcome our new witnesses on this new panel. I would like to remind participants of the following points. Please wait until I recognize you by name before speaking. For those participating by video conference, click on the microphone icon to activate your mic, and please mute yourself when you are not speaking. A reminder that all comments should be addressed through the chair. All virtual witnesses have conducted a mandatory witness onboarding test. You will now have 5 minutes for your opening remarks, after which we will open the floor to questions. So first we have, as an individual, Mr. Charles St. Arnaud. 5 minutes.
Thank you, Mr. Chair and honorable member of the committee. It's a pleasure to be here making my first ever appearance in front of the House of Commons committee. And thank you also for the opportunity of sharing my expertise with you. Household debt in Canada is elevated and has been exceeding 170% of disposable income for the past roughly 15 years. Canadian households are the third most indebted in the 44 countries that the BIS, the Bank of International Settlement, is tracking. We're just behind Switzerland and Australia. As a result of the elevated level of debt, the average Canadian household must spend about 15% of its disposable income just to make the obligated payments on that debt. That's including both interest and principal. But given that some households are debt-free, we can imagine that the debt service ratio is likely to be significantly higher for some proportion of the population. The high level of household debt renders the Canadian economy more vulnerable to shock. In recent years, household finance have been under pressure due to the erosion of purchasing power resulting from higher inflation and weak income growth and from higher interest rates. This had led to an increase in household financial stress. However, there are some signs that the economic system is flexible, allowing households to adapt to the higher interest rate environments. As such, while consumers' insolvencies have increased sharply in recent years and are approaching their highest level since the global financial crisis, the increase is mainly in proposal, mainly what could be seen as renegotiation of terms of those lending rather than bankruptcies. As a reference, bankruptcies are currently 40% lower than they were pre-pandemic and account for less than 25% of total insolvencies, compared to about 40% of insolvencies pre-pandemic and 80% of insolvencies during the global financial crisis. There is evidence that households are lengthening the amortization period of their debt to reduce the impact of higher interest rates on their debt payments. While this means that households will carry debt for longer and increase the total debt cost, it has prevented a surge in the debt service ratio in recent years, making their debt more sustainable. This flexibility only exists because household income has remained solid in recent years. The resilience of the labor market in recent years, characterized by a lack of major layoffs, has played a crucial role here. Any significant increase in layoff would leading to a decline in income would rapidly remove the flexibility in the system, with potentially serious consequences for household financial situations, Canada's financial system, and the economic outlook. Hence, the increased economic vulnerability caused by high level of household indebtedness. The high level of household debt has also had some broad structural impact on the Canadian economy. There is evidence that the constant high household borrowing over the past 30 years at an average pace of about 44% of GDP per year has crowded out business investment, thereby negatively affecting productivity growth over the past few decades. This is very similar to how big government spending and deficits in the late 1970s and 1980s crowded out business investment. The result can be seen in the fact that Canadians were recently spending almost as much as a share of GDP on home renovation and home ownership transfer costs, in other words, exchanging homes, than they did on machinery, equipment, and intellectual property. There is an important feedback loop between poor productivity, growth, affordability, and household finance. Weak productivity growth led to tepid salary gains and stagnant income. As such, disposable income per person adjusted for inflation, a measure of purchasing power, has been growing at a full percentage point slower pace on average over the past or since 2015 than it was between 1995 and 2015. This means that the cumulative impact of that slower gains in purchasing power means that Canadians have lost about 10% in purchasing power compared to where they should be if income growth had remained the same. Let me conclude with this important point on the subject. The affordability crisis and the increase in financial stress are as much an issue of underperforming incomes as they are of rising costs. And with this, I will happy to answer the members of the committee's questions.
Thank you very much. Next we have from Consolidated Credit Canada, Mr. Jeffrey Schwartz. 5 minutes.
Thank you. Mr. Chair, members of the committee, thank you for the opportunity to appear before you today as part of your study on consumer debt in Canada. My name is Jeff Schwartz, and I'm the Executive Director of Consolidated Credit Canada, and we're an accredited nonprofit credit counseling agency. We help Canadians consolidate and pay off unsecured debt, often at reduced or zero interest, while providing the financial literacy education that prevents debt crises before they begin. In the past year alone, Consolidated Credit supported approximately 125,000 Canadians through education, counseling, and debt management services. The average unsecured debt load among our clients was close to $20,000. I want to focus my remarks on 3 points today: the critical role of financial literacy, the need for consistent and equitable funding, and why accredited nonprofit agencies must be central partners in any national strategy to address consumer debt. Mr. Chair, education is our best and first line of defense. By the time a Canadian reaches our office in financial distress, the damage is often done. The goal must be to reach them before that point, before the impossible choice between heating the home and making a minimum payment. Accredited nonprofit agencies like ours deliver preventative financial literacy every single day. We teach Canadians how to budget, how to understand credit, and how to recognize the warning signs of economic abuse and coerced debt. This work is the foundational infrastructure for a healthy financial system. That brings me to my second point: funding. Accredited agencies are primarily funded by financial institutions through a share of the debt we help our clients repay, typically between 10% and 20% of the principal. This model works. Banks recover debts that might otherwise default, Canadians avoid insolvency, and the economy benefits from households that remain financially stable. The problem is that not every institution participates fairly. The majority of Canada's federally regulated institutions demonstrate leadership by contributing to this ecosystem. However, a small number of large institutions do not. These outliers benefit directly from our services, yet they do not invest a single dollar in the infrastructure that makes those outcomes possible. This is a free rider problem. It distorts the marketplace, it strains the capacity of agencies like ours, and ultimately, it harms the Canadians we are trying to serve. Our internal estimates suggest that if these non-participating institutions contributed fairly, Consolidated Credit alone could support an additional 21,000 Canadians annually, while significantly expanding preventative outreach to underserved and high-risk populations. We are asking the government to use the power of moral suasion through mechanisms like the proposed Code of Conduct for the Prevention of Economic Abuse to set clear expectations that all participating banks provide annual financial support to accredited nonprofit credit counseling agencies. Transparency is a powerful tool. Public disclosure of institutional participation would encourage fair play without the need for prescriptive legislation. Finally, Mr. Chair, I want to speak to our role as essential partners in the financial protection ecosystem. Accredited nonprofit credit counseling agencies are uniquely positioned to serve Canadians in financial distress. We provide client-centered care. When a survivor of economic abuse needs to untangle coerced debt from their credit profile, they need expert intervention, not a pamphlet. Government departments, financial institutions, and regulators should view us not as an afterthought, but as the primary delivery mechanism for financial literacy and debt remediation. We urge you to recommend that departments, ministries, and financial institutions formalize their partnerships with us and that the funding to sustain this work be consistent, equitable, and transparent. Now, in conclusion, Mr. Chair, Canadians are asking for a fair chance, a chance to learn, to recover, and to build a secure financial future. With consistent funding and genuine partnership, accredited agencies like Consolidated Credit can help tens of thousands more Canadians each year avoid the dead end of insolvency. Thank you, and I welcome your questions.
Thank you, Mr. Schwartz. Next, we have from Raymond Chabot, Inc., Guillaume Amiot. 5 minutes.
Bonjour. Donc, Monsieur le Président.
Thank you, Mr. Chair, members of the committee. I'm going to present my remarks in French. First of all, thank you for inviting me to appear as part of your study on the impacts of consumer debt in Canada. I'm a senior director in restructuring and insolvency at Raymond Chabot, a subsidiary of Raymond Chabot Grant Thornton. I practice as a licensed insolvency trustee, a profession regulated by the federal body known as the Office of the Superintendent of Bankruptcy, the OSB. I therefore work daily as a practitioner in consumer and business insolvency and restructuring. Please also note that I am president of the Conseil des syndicats autorisés en insolvabilité du Québec. This organization brings together nearly 225 licensed insolvency trustees practicing in Quebec. From the outset, I believe the premise of your study is entirely justified. My practical experience allows me to state that the problem goes far beyond macroeconomic trends and recent statistics, which show an increase in the household debt-to-income ratio and in consumer insolvencies. Indeed, the profile of Canadian debtors facing insolvency has changed in recent years. New groups of consumers who were previously underrepresented in insolvency cases are now appearing, including seniors, workers with fluctuating incomes, and single-parent families. In addition, the rise in mental health issues and the easy access to online gambling are factors that influence insolvency situations on a daily basis. For the middle class, insolvency is generally not the result of a single bad decision. It is rather a series of shocks and rising costs that gradually reduce their financial capacity. Many people live from paycheck to paycheck with little room to maneuver while the cost of living has increased significantly. Ultimately, it becomes difficult for consumers to balance their budget, and a life event such as an illness or a job loss can quickly push them into insolvency. When liquidity runs out, non-mortgage credit becomes a tool for budgetary survival. It is also at this point that many vulnerable households turn to high-interest credit or even payday loans to finance essential everyday expenses such as groceries. We should also note the situation of homeowner households. These households often lack liquidity, which, despite their accumulated liquidity, which complicates refinancing. And we need to take into consideration the value of the home. However, it cannot be offered to creditors without selling the house or without increasing their debt-to-income ratio. Before paying back debts, they're often obliged to move into housing that costs more than their mortgage. Another frequent problem involves online fraud. Vulnerable individuals, particularly seniors and those living alone, are especially affected. These individuals often contact us, and they're ashamed for having gone into debt as a result of malicious manipulators from the internet. Not to mention that a large number of debtors show a lack of financial literacy in that they struggle to distinguish between budget, income, assets, and liabilities. They often do not know the composition of their debts or their monthly income and expenses. The trustee then plays a key role in the debtor's financial assessment. In conclusion, I cannot overlook the important role of licensed insolvency trustees in the financial rehabilitation of consumers. We have little control over macroeconomic trends, but we remain the only professionals able to offer legal financial recovery measures to Canadian consumers. The regulatory framework currently under review by the OSB to facilitate access to simplified insolvency procedures and to adjust the compensation of trustees must evolve to ensure Canadians have access to licensed insolvency trustees. I will have the opportunity through your questions to further clarify the portrait of households in insolvency situations as well as the role and contribution of licensed insolvency trustees. I wish to emphasize that where we can make a difference is in limiting the damage and accelerating the return to financial balance for consumers. Thank you very much.
Thank you very much. We'll move into our first round of questioning, 6 minutes. We'll start with Ms. Cabina.
Thank you, Mr. Chair. My first couple of questions will be for Mr. Arnaud. In your opening statement, you mentioned that there's a crowding out of business investment, which of course will ultimately mean jobs for Canadians. Could you expand on that?
Yeah, what I mean in terms of crowding out is that the excess borrowing that we've seen over the past 30 years coming from the household sector actually reduced the availability of resource to be lended to businesses. A way of seeing it is that we're seeing in total lending in the financial system a constant increase in the share going to household at the expense of the share going to businesses. And that comes directly in link where we see also business investment in machinery, equipment, and intellectual property, which are productive investment, declining over that same period.
And you also made a comment around the increase in government spending and deficits driving low productivity. Could you expand on that?
Yeah, that was comparing what we're seeing right now with the impact of constant borrowing from households over the past 30 years to the situation that we saw in the 70s and the 80s when successive government, whether at federal and provincial level, were running extremely high deficit. And that led to a crowding out similar to what we're seeing right now, where business investment started to underperform significantly in the 70s and the 80s because of that excessive borrowing from government. We are not in that situation right now. Government borrowing is much lower right now than it was during that period.
Well, that's important to know, of course, because we want to look at the trend of borrowing, but thank you for that. My next question is for Mr. Amiot. The Prime Minister has stated in the House that affordability is the best it has been in over a decade, yet consumer insolvencies reach 140,000 filings in 2025, which is the highest volume since 2009 and the second highest since your office began tracking in 1987. I think it was in your opening statement. So could you speak to this trend of consumer insolvencies and what is driving that?
Oui, certainement. Juste pour vous dire, en fait.
Yes, absolutely. My office doesn't collect insolvency statistics. It's from the insolvency office that appeared before. However, I can say that in practice, we see an increase in insolvencies, which is related to budgeting, which has been impacted by the successive increases in inflation and by various categories of expenses, food, housing. So yes, this has certainly made the consumer more fragile, and there's a certain impact where the average consumer in our office is a person who has experienced a life event, losing a job, an illness, a situation that had a significant impact on their financial capacity. And now it's people who have accumulated more and more debts at higher rates. They've used their credit card as a survival tool just to pay their daily expenses. So this is something that we saw less of in the past, but we see more of now. I'm not sure if I answered your question.
That was good. And it actually reminds me of yesterday, where there was a senior in my riding in Aurora who approached me and said, I was looking forward to retirement. I had worked very hard, but because of the cost of living, I have been forced to go back to work, and obviously he's older, he's tired, and I've known this senior for 21 years. He's still living in the same house, so very fiscally responsible. So would you agree then that affordability is in fact getting worse, and that it's not, in fact, the best that it has been in the last decade?
Évidemment, je ne suis pas économiste, donc pour moi, c'est difficile.
I'm not an economist, so it's difficult for me to take a look at specific trends. However, in our office, this is something we see. People have difficulty making ends meet more and more frequently. And the clientele that comes into my office, I see that they have difficulty in terms of affordability for certain essential goods. And at the beginning, I said that we have very little control over the macroeconomic situation. But of course, the macroeconomic situation affects people's ability to balance their budgets.
Well established that the cost of living is a central driver for insolvency, particularly the rapid rising grocery prices, which are up 30% since 2019. Do you believe that reducing costs on transportation inputs, for example, by removing federal taxes on fuel, could help keep the prices of food down and then relieve this pressure on insolvencies from Canadians?
C'est une excellente question.
It's an excellent question. Again, unfortunately, I can't comment on the major trends that this measure could bring about. I'm not an economist and I'm not a legislator. It could bring about a certain decrease in the cost of food. We spoke about the fact that 9%.
Next, we have Mr. Lavoie for 6 minutes.
Merci, Monsieur le Président.
Thank you, Chair. Hello to all our witnesses. Thank you for being here. And Mr. Amiot, this is the first time you've been at a committee. You'll see that it'll be fine. And I'm going to ask an easy question, like I asked to our previous witnesses. In your opinion, is access to credit too easy for consumers? It's a great question.
Pour moi, en fait,
Avec la facilité d'accès en ligne.
You talked about how easy it is to gamble online. So you already touched upon this subject. Yes, well, online gambling is a very unique problem. But in terms of access to credit, in my office, I see people who are in a difficult situation. They need to choose between buying groceries and paying their rent. For me, and I'm not saying it's a fake debate, but it's become a survival tool for people. So I'm not really familiar with its potential. And you say that people come to your office who are in a bankruptcy situation. I worked in a bank for 20 years, and I dealt with businesses like yours. And often these aren't people who have a really high credit card bill. Is it just for groceries and for rent that they come to you for? As far as I understand, when people are in the situation of bankruptcy, it's because they have 4 or 5 credit cards and they use that one credit card to pay off another. So is that what you see for the most part? And then rent and groceries as well? Well, what we see is that yes, the use of credit with high rates brings about insolvency. So why do we use credit? It's often because our budget's not balanced. The budget is not balanced because expenditures have increased and income hasn't. So yes, sometimes we can see food costs and housing costs that have an effect on the budget. One's mortgage that has perhaps increased as a result of increased interest rates. And so in your opinion, people who use credit cards, is it mainly because they're not able to pay their rent and so they had to use credit cards? No, these are consumer expenses. We see fewer people putting huge expenses on their credit cards, but we see recurring expenses. We were talking about COVID and the COVID period, and an anecdote was told, and I'm wondering if it's true, in terms of the experience of your type of business, because there were fewer bankruptcies during COVID. Did you hear anything about that? Well, it's a little bit comical as an anecdote, but yes, there were far fewer bankruptcies during the pandemic because people changed their behavior. They had more savings. People paid off their debt more. And so if we talk about behavior during the pandemic compared with normal periods, can you draw a parallel between the people who come to you and talking about rent and groceries? During COVID, the cost of living increased and people's savings went up and their debts went down. So can you explain this duality based on what happened between COVID, and can you explain what you were explaining just now? The fact that people's grocery bills are going up and they're using credit cards. So why was it the opposite during COVID? I just want people to understand this difference in consumer behavior. in terms of statistics, as far as I understand, based on the stats that I've seen. No, I'm not talking about stats. I'm talking about your work. In terms of the increase of costs, yes, there were increases during the pandemic, but before the pandemic, there was significant inflation, and that needs to be taken into consideration. And during the pandemic, people received a lot of government assistance, which allowed them to balance their budgets. People who had precarious jobs, they were able to access the various government assistance, which allowed people to create an emergency fund via these government payments. So are you telling me that people enrich themselves with these government payments because you said they created an emergency fund? No, I'm not saying they enriched themselves, but at the time, the fact that people were able to receive these government payments allowed certain people, yes, to have a kind of an emergency fund during the pandemic because they had less expenses, they were going out less, things were closed. And so, with respect to those who paid off their credit card and saved a lot, who didn't receive these government payments, how is it that they were able to do that then and they can't do it today? Well, these people don't come to my office, so I can't comment on them. And very quickly, Mr. Schwartz, thank you, Mr. Amiot. You said that there are banks that aren't contributing because you're a nonprofit. And what banks are you talking about in Canada? Well, you open the door.
Just a short answer, please.
And I wish I had a complete answer, but I can tell you that we are a nonprofit credit counseling agency. We're the largest in the country. We're helping Canadians coast to coast to coast, and we've been doing it for almost 20 years. I'm not here about pointing fingers. I really want to look forward and what we can do or what this committee can do and what they can enforce.
Thank you, Mr. Schwartz. That concludes that round. Next, we have Mr. Garon for 6 minutes.
Merci, Monsieur le Président.
Thank you, Chair. Thank you to all our witnesses for being here today. It's a pleasure to hear from you. I'll start with Mr. Amiot. I'm happy that you accepted our invitation, and I listen to you often on Francis Gosselin's podcast. I'm not trying to advertise for anyone, but you explain things very well. And in terms of financial literacy, we need people to explain these things. And socially, collectively, I think this is a very important role, and you do it very well, so congratulations. And I'd like to come back to your role in insolvency, and not necessarily for bankruptcy. In your role, you assist people in bankruptcy, but you also help people get out of insolvency without moving towards bankruptcy. So people who are in this situation, you talked about solutions, people who sell their homes to end up paying rent that's higher than their mortgage. And we don't find these things in statistics on bankruptcy. So what kind of statistics, how can these statistics perhaps underestimate the extent of the difficulties, financially speaking, being experienced by households in Quebec, for example? Thank you for your comment. Very kind of you. The question is interesting. A trustee's role is much broader than simply dealing with insolvencies or consumer proposals, which is another option set out in the Act. But we're there to assist the debtor in developing their budget and in implementing other measures outside of the Act. You spoke about mortgage credit and referring the client to other solutions, not just legal solutions set out by legislation. And you're right. In terms of stats, yes, we have stats for people who formally declare insolvency, and we need to make a distinction because insolvency files, 140,000 or so of them, these are not all bankruptcies. 78% of files are proposals, consumer proposals, which is an agreement with creditors and based on the assets, based on the ability to repay, but it's an agreement set out by legislation that allows debts to be dealt with without moving to bankruptcy.
perspective, je pense dans
And so we need to put these things into perspective when we take a look at the stats. But yes, there are all kinds of other solutions. And what we also see is that people are waiting longer and longer before they move to the ultimate solution, which is the proposal or bankruptcy. They become more indebted. They use many credit cards, 2 or 3 credit cards, like we mentioned. And it's because people are hoping that their situation will stabilize, which isn't always the case. Thank you very much. That was very enlightening. I'd like to come back to a question that I asked one of our first witnesses. And especially among young people, it seems like young people are more and more interested in financial issues, whether it's financial literacy improving. We've spoken about Freedom 45, but there's really a movement in the area of financial literacy among young people. And as members, of course, we take a look at social media, TikTok, etc. And it seems to me that people have never been subject to so much fake information, fake coaches who say, get involved in real estate, it's easy. These fake coaches in investments. And it's more and more difficult today for someone to understand what's fake and what's not. These people often don't have any kind of training or certification. So in your office, do you have people who have been subject to these kind of influencers and who have become vulnerable and then made a series of bad decisions? Well, you're absolutely right. It's something that we see more and more often. Often people get their information from the various platforms on the internet, or they even use AI, which is often contaminated by fake or misleading information from other platforms. And the bankruptcy, the Office of the Superintendent of Bankruptcy provides information on indebtedness, and they make sure that there aren't any fake advisors who are enriching themselves at the expense of consumers by providing advice which can be negative. I think that more can be done. We can always do more, but it's important that we keep this situation under control and that we continue our work to put an end to this kind of information. And the profession of trustee is important because we're at the front lines for these people. And we have a license, we have a code of conduct. And so the information that consumers get, we make sure the information is good. Do you think that when it comes to social media, we should oblige these people who claim to be financial coaches? Should we oblige them to make their certification known to the public? And this could be done by various levels of government. I'm not sure how feasible this is, but yes, that would be very interesting to have this kind of obligation to make these certifications public.
Mr. Kelly, for 5 minutes.
The level of indebtedness is rising. The Canadians are reporting that they're getting deeper in debt, and that the size of credit, outstanding credit, is growing, but the number of participants is not really growing much. So in other words, people are getting deeper in debt. We are not seeing a new crop of young borrowers that are able to get into home ownership. We are simply seeing people getting deeper into debt. You talked about the some of the consequences of that, but you also said in your opening remarks that while there is flexibility, and we have heard that people are depleting their savings, they're refinancing their loans, and they're cutting back on other expenses, including necessities. But the kicker here is unemployment, that if people experience a loss of income, then that is what triggers insolvency, bankruptcy, and in your words, erases the flexibility. So could you talk about that? And let me ask you if you are concerned about the recent unemployment figures, where we saw 108,000 full-time jobs lost in February.
Yeah, thank you for your question. as I was explaining, a lot of the flexibility in the systems come from the fact that households haven't had an income shock in recent years. Yes, the unemployment rate has increased, but most of it has been due to more people coming into the labor force than actual big layoffs. Yes, I agree. Since the beginning of the year, we're seeing something a bit more concerning there, where we've seen some job losses. And the concern is that considering how much the average household has to spend of its disposable income to service that debt, the question is what will be the consequences of losing that income? And that means that a lot of the flexibility that was available to them, whether it's lengthening the amortization of their loans and so forth, disappears suddenly, and that will be pushing them toward insolvencies. And that's a question. And for me, when I look at it as a macroeconomist, that's where I'm concerned. When it makes the Canadian economy much more susceptible to negative shock, because if you have a critical mass of job losses, you could have a big wave of households falling behind and having an increased wave of bankruptcies and insolvencies that would have further negative impact on the economy and on the financial system.
Because right now, I mean, Canadians are not getting further ahead. We have seen over the last 10 years virtually unchanged per capita GDP. So incomes are not growing. You mentioned that for the majority of Canadians who are still working, they haven't experienced an income shock, but they are not seeing growing incomes. The per capita GDP is flat, so higher costs are simply coming out of their ability, their enjoyment of life, their ability to pay for things other than necessities. But now we are seeing the unemployment rising. So are you concerned that it's not a matter of higher incomes or a growing economy that is forestalling what would otherwise be a debt crisis, that we're just barely getting by?
It's really at the moment what I feel that has been controlling or helping the economy and preventing the increase in insolvency, considering all the shocks from underperforming purchasing power, considering increased costs, considering higher interest rates than what we've had in the decade pre-pandemic. The fact that households haven't seen the income shock has allowed them to weather all those shocks better than it was otherwise. The concern is going forward. Each time we get a negative shock, we need to be careful that if we see a big wave of a rise in unemployment rate and layoffs, that could unravel very rapidly.
All right, only a few seconds left. So is that your top concern around this extremely high level of indebtedness? Is unemployment the key to this?
Well, the employment is key to this. It's a very strong or a big vulnerability on the Canadian economy that could make a negative risk even bigger in terms of negative shock on our economy. But as also, for me, what's important is all the structural impact that what brought us there, that high level of debt and that increase in borrowing, has actually also linked to our weak productivity.
Mr. Next, we have Mr. Letteo for 5 minutes.
Très bien. Merci beaucoup, Monsieur le Président. Alors, Monsieur
Thank you, Chair. So, Mr. Saint-Arnaud, we could perhaps continue discussing these issues.
Votre comment.
I very much appreciated your comment on the level of indebtedness, the relative one, of course, and the fact that it's remained fairly stable over the last 10 years, but these levels are high.
De gérer cette situation.
And we're able to manage the situation, but of course, it means more vulnerability. So, you mentioned the concept, or not the concept, but the issue of excessive indebtedness among households.
Je comprends très bien les conséquences de cela.
And I understand the consequences of this. But do you have an idea or a theory as to what brought this about? Why in Canada do households have this increased debt load over the last decade? Well, there are different ways to explain it.
Pour répondre à une question si...
And to answer a question from your colleague, I think that access to credit is very easy for households and has been so for a number of years.
Une facilité plus grande pour les ménages dans...
And so households have an easier time borrowing, even more so than businesses, and that has increased their debt. And of course, we can't forget that we went through a post-financial crisis period at the end of the 2000s to about 2010, where interest rates were extremely low for a long time. And this allowed households to increase their debt load without experiencing consequences in terms of their monthly payment. It allowed them to buy a bigger house because interest rates were low and their mortgage payment was lower. So all of these things together helped. But we need to use a more macro point of view. We could even say that it's related to productivity. In Canada, we had a bad growth model for the last 30 years where we very much focused on economic demand, especially from households, to the detriment of supply. And so the way that we increase productivity and investments in business, we can't forget to consume, households need income. This income depends on their wages, and these wages depend on productivity increases. So after about 30 years, that's where we are. The elastic band has been pulled tight, and now we're experiencing these significant problems. The member for Mirabel agrees. And I do as well. I think we focused way too much on supply, or demand rather, especially given the extremely low interest rates and given all of the measures which were then put into place to facilitate access to credit, 30-year mortgages with a $0 down payment. And this led to significant indebtedness. So my question is, how are we going to resolve this? And I think it will be resolved by focusing on supply, whether it's measures, public policy that serve to target the measures to increase Canada's productivity. So do you not think that we also need to be careful when it comes to consumer debt? Because if we do things too quickly, that is to say, putting into place measures to improve supply, business investments, etc., that might create a credit shock for consumers. If credit becomes cheaper and less available, could that not trigger problems? Yes, I agree. We need to, of course, find the balance between these two approaches, and there needs to be a reduction of indebtedness, which is relatively gradual.
That round. Next, we have Mr. Garand for 2.5 minutes.
Merci, Monsieur.
Thank you, Chair.
Revenir avec vous, Monsieur Amillot.
Mr. Amillot, I'll come back to you.
Monsieur Letao has dit qu'on...
It's great that Mr. Letao said that we agree on something. It can happen from time to time.
Monsieur Amillot, j'aimerais...
Mr. Amillot, could you talk to us about seniors? In the document that you provided to us, you said that some seniors are having a lot of difficulty. They come to your office and they want to restructure their debt. So what is the typical profile of someone over the age of 65 who has financial issues? Is this a result of being having a fixed income, or they have to go back to work? Perhaps in the next 90 seconds, you could give us a profile of one of these individuals.
plus dans nos bureaux. En fait, c'est
More and more often, we're seeing seniors who are fixed income, whether they're receiving a pension or other kinds of government assistance, and often these payments are quite low, and these people have a limited ability to increase their income, and they sometimes have to return to work. And so people who come to our office aren't necessarily owners of real estate, and they're often people who receive government assistance or people on fixed income.
moins, disons, de capacité ou du moins.
And these seniors
Donc,
are less familiar with the internet, so often they're victims of online fraud. People come to our office who have often spent all their savings as a result of one of these situations of fraud, and they're often compensated very badly. And these people, some people come to our office who own a home, but they've experienced inflation, and so they've had to borrow against their homes. We've seen reverse mortgages, these kinds of products, which generally have rates that are quite high, and they're quite unadvantageous for these people.
So for our last round, we have Mr. Eric Lefebvre for 5 minutes.
Merci, Monsieur le Président. Merci à nos trois.
Thank you, Chair. Thank you to our three witnesses. My question is for Mr. Amiot. And we spoke about a debt ratio that's too high among Canadians, and people are using credit cards. They're in survival mode from month to month. So it's heartbreaking to know that families are experiencing this, and we know that the cost of groceries, of rent, of gasoline. And Mr. Chair, we've made proposals to reduce this burden on Canadians, and I'd like to know what, in terms of the people that come to your office, would you say that now we're even seeing couples where both people work, but they're in an emergency situation like this? Yes, well, all kinds of people come to our office. People who are well off, or people who have very, very low income. But the common denominator is liquidity. Because even people with high incomes, yes, have access to a property and to equity, but this equity is not accessible because their debt ratio is too high, and so they won't get approved. And they don't even have the budgetary ability to pay a higher mortgage payment. So yes, these are people in the middle class, even people with high income. We have people from every level who come to our office. And someone's budget fluctuates over time, but it's hard to adjust it very quickly. So if someone has recurring expenses, paying for their car, paying for their mortgage, can't just overnight change these payments. And so that's why, yes, we see all kinds of people. And so in terms of this particular group, would you say it's gotten larger over the years? If we go back 4 years in the past, did you not see these people? People who are homeowners, well, we saw that very rarely over the last number of years, and we're seeing them more and more often. And so in a proposal, well, you need to compensate for the equity to our creditors. And even if this equity gets spread out over a long period of time, well, they're not able to pay this equity. And as I said in my remarks, people sometimes have to sell their home and start renting, and then they end up paying a higher rent than their mortgage because that's what the Act sets out. And as a result of the compensation for equity. And it's sad, Mr. Chair, if people want to use a leverage effect, well, they often do so with their principal residence. And so they're trying to build wealth, but unfortunately, they have to sell it at a loss in order to pay their debts, and they find themselves in a rental situation where they're paying even more than what they were paying for their mortgage. It's unbelievably sad. My next question is for Mr. Santelno. Mr. Santelno, you spoke about our economy, which is more vulnerable to shocks, and I'd like for you to tell us about this. You also spoke about our business's low productivity, and we are a few decades behind what's being done globally. And so I'd like for you to tell us a little about what you were saying about the vulnerability of our economy. Yes, all these things are linked. Vulnerability means the next negative shock, the next job loss will have more significant negative effects compared with what we've seen in the past as a result of the high indebtedness of households and the repercussions that this can have elsewhere. But we also need to recall that some problems related to indebtedness, well, are related to the fact that Canadians' buying power has stagnated significantly over the last few decades. So this doesn't help. And so all these things are interrelated. And we really need to emphasize the importance of increasing income. Yes, we can provide short-term assistance to households, but what will really make a difference is, in the long term, having real inflation-adjusted incomes that are higher, and that will mean more leeway for Canadian households. And that's where productivity is very important.
Now we're going over to Mr. Sawatsky. Last round. 5 minutes.
Thank you, Chair. Mr. Schwartz, you had mentioned preventative financial literacy. I think this is an important thing to talk about. I was curious to get your take on the rise in online gambling. Have you seen this affect people financially? I just wondered if you had anything on that.
Anecdotally, we do see gambling as an issue amongst our clients that come to us, and it really is a matter of, well, what can we do to stem that so that it doesn't continue, and how can we get them back to a point where they can afford their payments? So they've accumulated all this debt, and it's usually high interest rate debt, and what we're trying to do is work with their creditors to get it to an affordable rate for them to pay it off, and also we encourage them not to take on additional debt and count themselves out of the gambling situation.
Absolutely. And are there any things that you find yourself when you're giving financial literacy advice? Are there any things you find yourself repeating a lot, things that more people maybe should be aware of?
One of the things that we have saying in our office, you can't borrow your way out of debt. So taking on additional debt is really going to exacerbate the issue. So what we're trying to do with our clients is say, okay, what can we do to get you to a point where you're just treading water? Right now you're sinking. Let's get you to a point where you're treading water. And then the next step is to build savings. So around financial education, the best combat against debt is savings. So if you have these unexpected expenses or something that creeps up that really takes you off of your track, you have a savings plan to be able to handle that and move forward without taking on additional debt for that expense.
So have you been seeing a significant amount of people taking on additional debt to pay off other debts?
Yes, and that's usually the first question that comes is, well, can you get me a loan? And our first question back to them is, well, what do you need the loan for? And it's typically to service other debt. So we want to get them into a situation where not only can we restructure their existing debt so it becomes affordable, but also while we have them working with them, have them change behaviors so that they can get ahead of this and not go into the same pathway.
Thank you. Are there any other things that you find yourself consistently bringing up as well?
A big thing is the education, is financial literacy. And I know previously the FCAC talked about it, but we need to do a better job. There's nothing that irks me more when someone comes to us and says, well, you're the best kept secret out there. No, we need to be front and center, and we need partnerships with the financial institutions to refer people to us as a first stop.
Yeah, absolutely. So how, for anyone who isn't familiar, how can they get in touch with you?
We're all over the internet. We're the largest nonprofit credit counseling agency in Canada. We help hundreds of thousands of Canadians every year. So just to search Consolidated Credit Canada, you're going to find us.
Absolutely. In terms of, I was just wondering if you could maybe speak to the broader economics of internationally right now with everything that's going on. For example, the Strait of Hormuz being closed, and like, how do these international events affect people's day-to-day expenses?
We're hearing this every day, multiple times a day, because what's happening is it's putting an additional strain on their finances. It's showing up in the grocery store. It's showing up at the gas pumps. It's showing up everywhere for them. And in addition to that, and I know it was alluded to earlier, there's some concern about job loss and job reduction. So as a result, these are putting strains on people's finances, and we want to get them to us sooner than later so that we can change behaviors and hopefully we can get them treading water again.
Thank you. And when it comes to federal policy, are there any things that the federal government can do to help out what you're doing here?
Well, I think mandating and one of the things that's come up recently is the Code of Conduct on Prevention of Coerced Debt. And I think mandating that the banks support and move people towards credit counseling as opposed to further debt is something that's going to help Canadians. And again, I said before, the biggest defense against debt is savings. If we can get people, even in a small way, to putting money towards savings and having banks push towards that, that's going to benefit Canadians in the long run.
And what percentage, roughly, of people do you think are kind of thinking about saving? Are there a lot of people that are familiar with how important that is?
I'm going to suggest to you probably not. I think we hit an all-time low of between 2% and 5% prior to COVID, and then over time we've seen it uptick a little bit, but I think it needs to be far more than that. And we encourage Canadians to save between 3 months and 6 months of their budget and have that put away for a rainy day, because those unexpected expenses happen all the time, whether it's a dental emergency or it's your washing machine breaking. You're going to have to deal with it instead of going deeper into debt.
Thank you, Mr. Schwartz.
This is a better way.
That concludes our round, and I just want to thank all the witnesses. I look at Mr. Kelly as I ask this. Is the will of the committee to adjourn the meeting? Okay, thank you, everybody.